Hi everybody, Ahmad Sadiq here from Land Trust Title of Central Florida. Let's talk title. Today I wanted to spend a little bit of time talking about types of transactions that we've seen here recently where we have sellers that are selling properties, but on the properties they have secondary liens, mortgage liens, which are partial claim mortgages. And I wanted to talk about how this impacts the title transaction and how it's going to impact the sellers, not only in terms of the sale of their home, but just in general in terms of titling the property and how it could impact them in terms of their ownership and what they can do with the property. So ultimately, a partial claim mortgage is a mortgage that's taken out if the primary mortgage is past due. So if there's an arrearage that's owed back to the bank because they haven't been making, the owners of the property haven't been making payments for a period of time, they can take out a partial claim mortgage, which essentially covers the past due balance, any interest, any other fees, late fees, things like that that have been accruing over a period of time, and that secondary loan would be used to bring that primary mortgage up to date so that it's not in a default status. Ultimately, that amount that's paid to the primary bank is going to be held in a secondary loan that's going to be called a partial claim mortgage. Now that partial claim mortgage attaches to the property as a lien and a no interest payment over the course of the ownership of the property. And so ultimately what's going to happen is when we do our title search, we're going to see the primary mortgage and we're going to see one or several partial claim mortgages that are liens against the property. Now what does that mean in terms of the actual owners of the property and how they can utilize the property? Well, first, when it comes time to sell the property, they're going to need to make sure that they're going to be paying off not only their primary mortgage, but any and all partial claim mortgages that they've taken out over the course of their ownership of the property. The difficulty that we have is, in many instances, owners of properties don't realize that they have a secondary loan on the property. The process is probably not clearly explained to them when they're going through the entire process with the bank, and a lot of times we see sellers that believe that the primary mortgage is the only mortgage and whatever loan that they've taken out has already been taken care of, and they're surprised to see that there are additional liens on the property for payments due. The benefit for us is because those payments are non-interest, that means that we know what the payment is going to be. We just need to get a payoff from the proper entity so we can take care of that. So that means that in many instances, sellers of the property might not be aware that there's an additional $20,000 or $20,000 or more worth of loans that need to be paid off, and they may be expecting a certain amount of money at the close of the transaction. They're going to get something significantly less than that because that mortgage is a lien on the property. Now, what does that mean for you as real estate agents? Well, when you're having conversations with the sellers at the time of the listing appointment, you want to ask them if they have a mortgage on the property. And you want to take it a step further and ask them if they've ever been behind on mortgages and if they've ever had to work with the bank because they've had some back due payments, to sort of get an idea of whether there may be some additional amounts due, so that when you're communicating with us at the title company, you can let us know, hey, not only is there a primary mortgage, but the seller did indicate that they had to work with the bank to get their payments up to date and that there might be a secondary mortgage. We're going to catch it on our title search anyways. However, for you guys as listing agents, giving your sellers a proper foundation in terms of what they should expect at the time of closing, in terms of their net, it's really important to have that conversation with them so that you can be reasonable in terms of the expectations of their walkaway. Now, as homeowners, there's an additional impact that happens when you have a partial claim mortgage. The way that those partial claim mortgages attach to the property is either you're going to pay that amount back at some point in the future, usually 30 or 40 years down the road. If the amount hasn't been paid by then, that amount is going to be owed back. Or when you sell the property, which we will find at the time that we do our title search and try to close the transaction, that amount's going to have to be paid back to the bank. And then lastly, if you're a homeowner and you're trying to refinance your home, you have to understand that that partial claim mortgage is going to have to be paid off at the time of the refinance. That's one of the contingencies of partial claim mortgage, is that it's paid back either at the expiration date, the maturity date of the loan, at the time the property is sold, or if there's a refinance on the property as well. So in terms of creating proper expectations for sellers, it's important to have these types of conversations with the sellers at the time you're having a listing appointment with them, and then conveying that information to us at the title company so we can also be prepared and explain that very appropriately and very clearly to the seller so there's no misunderstanding. We're not at the closing table and the seller is asking us, why is there an additional $30,000 on the property? We thought it was just a primary mortgage. So we want to make sure that proper expectations are met for the sellers, and we want to make sure that your communication with the sellers is also effective so that we can all act appropriately to get this transaction closed. Guys, thank you very much for watching. See you next time.